Welcome everyone to an introductory video on delta trend continuation analysis. In a trending environment in trading, consuming liquidity refers to the process where large market participants such as institutional investors or high-frequency traders absorb the available liquidity in the market as the trend progresses. Liquidity consumption happens when buy or sell orders are continuously executed, absorbing the available resting orders inside deltas at various price levels. In an uptrend, delta liquidity consumption occurs as buying pressure continues to absorb sell orders. As the price moves higher, limit sell orders at each price level are filled, which can result in higher highs and higher lows in terms of price action. On the other hand, in a downtrend, delta liquidity consumption occurs as selling pressure absorbs buy limit orders. As the price moves lower, buy limit orders at each price level are filled, which can result in lower lows and lower highs in price action. Large participants may place substantial buy or sell orders to consume limit order liquidity inside deltas. This can create a vacuum where the price moves quickly until it finds the next level of significant liquidity in the next delta. Observing volume spikes and order flow can provide insights into liquidity consumption. High volume during trend continuations often indicates liquidity consumption by larger players as they aggressively throw orders to eat resting liquidity. Traders can use delta trend analysis patterns to follow the trend. If buy orders are consistently absorbing sell orders and taking prices higher, it indicates strong buying pressure, and vice versa. Traders can look for pullbacks within the delta trend continuation pattern where liquidity consumption slows temporarily, presenting opportunities to enter the trend at a better price. Understanding liquidity consumption in a trending environment is crucial for traders looking to align their strategies with the market's directional movement. By observing how liquidity is consumed at various price levels and incorporating tools like volume analysis and order flow, traders can make more informed decisions about entering, exiting, and managing their trades within the context of the prevailing trend. Now let's observe the illustration and analyze what larger players do with the delta liquidity in terms of price action when they want to push prices aggressively in a certain direction. Firstly, on a very basic level, we see that price touches the sell delta. This touch is very important as it makes a pullback and continues the move to the upside. So here we can mark it as 1 and 2. There are different structures after this, but this 1 and 2 will become and act as price levels that provide support every time the price comes back for a retest. Once the price gets into the manipulation zone, we mark it as 3 and now wait for a pullback inside that range of 1 and 2. As the price enters that range, we now wait for a price action pattern to complete, which would be 4 at the bottom. Then it makes a small pullback to the upside and comes back to retest 4. Once that high gets broken, we mark it as 5 and place our fib from point 5 and drag it to point 4, waiting for the price to hit the golden zone so we can look for buying opportunities. If we see that the trade is going in our favor, we can then keep an eye on any momentum break closer to 3 or a micro break of structure to the downside. In that case, we can take a small win and close our trade. If, for instance, we see that the momentum is carrying on to the upside, we can stay in that trade until we see a weakness in buying or a micro break of structure to the downside where this trade can be ended. There are different structures involved in a trend continuation setup that I will explain in future videos from live price action charts. Now let's dive into a buy trend continuation analysis example. Here we see as price entered the buy delta, that first touch becomes key in this pattern. As it makes a pullback and falls below, the upper price becomes 2. The price then goes inside the manipulation zone, and that point becomes 3. Now we wait for a pullback retest of the range that was formed previously being 1 and 2. As the price comes up, we see the highest point formed being 4, and once a break of structure to the downside is made, we mark it as 5. Once that happens, we plot our fib from point 5 and drag it to point 4 and wait for a pullback in the golden zone to look for possible selling opportunities. If the trade goes in our favor, We keep an eye on it as it approaches point 3. If we see any weakness in selling, we can simply close our trade. By weakness, we mean a break of structure to the upside on a micro level. If it continues in the downward movement, we can then wait to see a break to the upside and look to close the trade then. Remember, this is just a basic structure that we are discussing. Structures differ on each setup, but the most important factors in this analysis are points 1 and 2 that become our base, then the formation of 4, 5, and 6. In later videos, I will share in more detail what larger players do there by taking out number 2 by a very little margin and then continuing with this price action pattern in the same direction as stated in the screenshot. From an order flows perspective in such scenarios, we observe exhaustion. That is all for this introductory video. I hope you all gained some knowledge from it. Thank you for watching and see you all in the next one.